Let's connect with Jonathan Ghana, Chief Asia and Emerging Market Strategist with Morgan Stanley, who joins us from Hong Kong. Jonathan, morning. Thank you for joining us. Jonathan, how do you map flows into China and India in next coming months, especially from the ETF market?
Well, we had some quite significant fund inflows at the start of the year in January and February. More recently, we've strung together a series of outflows that are not actually that large. But we're heading to a time of year when traditionally fund flows are not positive. But towards the end of the year, we would actually expect improved economic performance in both China and India will start to yield positive inflows again.
Jonathan, hi, morning. Looking at the China rate cut, how will that impact the country and other Asian countries as well?
Well, we think it's hugely important that China has begun an interest rate reduction cycle for the first time in 4 years. This follows earlier movements to relax lending restrictions and reserve requirements. What we're really starting to see is a package of measures to support growth in the face of a slowdown in global trade. So we are more optimistic than the consensus about China's economy picking up from the second quarter onwards, and we're still expecting about 8.5% GDP growth for the year.
Jonathan, Cyprus has been simmering for a while, and it's official now that Cyprus needs a bailout. So how do you think this will change life for global markets?
Well, this is not news that had been talked about before. I think the bigger issue is around Spain and Spanish banks. We'll find out more about the actual concrete proposals at the upcoming summit, and we'll also find out more about proposals to move forward on banking union and fiscal union. But I do think out here in Asia, we are, as I mentioned earlier, in any case expecting more rapid GDP growth, supported by policy easing in the second half of the year than we saw in the first half of the year. Many of our markets are trading on valuations that are exceptionally low to history, at levels which backtest for very strong returns 6 months out. And whilst we're working through these issues in Europe, and that will take a long time, I don't think it detracts from the value on offer in equities out here in Asia.
So, Jonathan, what's your view on global risk after Operation Twist being extended and the EU situation post the Greece election outcome?
Well, my colleagues are still quite cautious on Europe in particular. And obviously we have an outright recession that's already begun there. That's very different from the economic environment here in Asia. We tend to have more upside to our target prices for Asia and emerging markets, and also for Japan, than we do for either Europe and the US. So overall in equities, we would expect Asia to be doing considerably better than Europe and US in the second half of the year. The US is trading on very high valuations now relative to Asia. And the US also has to face the fiscal cliff at the end of the year, which is obviously potentially of global significance, but is primarily a domestic concern.
So, Jonathan, how exactly are you viewing investor sentiment in Asia?
I think investor sentiment in Asia is pretty subdued. As I mentioned, it's a time of the year when typically we don't tend to see very large fund inflows. Earnings revisions have been somewhat negative. It was a tough first half, particularly the second quarter, but we think the second quarter is the trough for this cycle in terms of Asia's economic activity. So we would expect that sentiment to improve going forward.
And what sectors do you like in India, and what is it that you're recommending to avoid?
Well, in India, we really like the consumer, selected pharma and software names. And we also have a couple of picks in the private bank sphere. We're much more concerned on the state-owned banks, on the industrials, capital goods, the infrastructure plays, where we're really not seeing a pickup in government delivery to help those sectors.
Jonathan, what have you made of the recent developments in India, where Reserve Bank of India has tweaked some ECB borrowing norms and they have increased their FII limit in the debt market?
Well, India has an external vulnerability. It's running twin deficits on the fiscal and current account side. It's got relatively lower reserve coverage of its external obligations than the average country in Asia. And that may have played a role in limiting the interest rate flexibility of the RBI, though the oil price certainly going lower does help in that regard. And India is taking steps to try and improve its balance of payments position. Overall on the India market, it's not one of our preferred markets currently. We are actually underweight.
So what's your outlook on Asian equities over the next 6 months?
Well, as I mentioned earlier, we think the back tests are pretty good. We're on a forward P of about 10 times, historic price to book of around 1.5. Dividend yield is more than double that of the global risk-free rate, the US Treasury yield. These back test over 20 years of history for returns, really quite high returns, between 20 and 30% over 6 months, the sort of returns we had from November through early March last year. But we do need to see that economic activity picking up